The Uday Kotak-led Committee on Corporate Governance Reform submits its report to SEBI, recommends at least 6 directors on the board of a listed company with 1 independent woman director, also suggests splitting the roles of chairman and MD and CEO. SEBI gives time for public comments till the 4th of November.
Fortunately, the nation that is still growing at a good momentum.
Don't worry about September. Worry about 2018 and 19.
The GDP growth rate will catch up in the July-September quarter.
A day after Prime Minister's vociferous defense of the economy, top corporates repose their faith in the India story. Majority believe the current slowdown is just a short-term blip at the World Economic Forum's India Economic Summit.
There is a slowdown as a result of the GST. There are still a few operational issues that are being ironed out.
Teething troubles with GST remain the main concern for CEOs at the India Economic Summit. Many claim supply chain disruptions and some operational issues.
Some amount of check and balance on where the money is going, what's happening with large amounts of currency is good.
Shift towards a digital economy is natural, says Railway Minister Piyush Goyal. Also adds that the government is not forcefully leading people to go digital. That's another exclusive.
Government has been very keen that the macroeconomic stability should not be disturbed.
DIPP Secretary Ramesh Abhishek tells CNBC TV18 that the government won't take easy steps to relax the fiscal deficit target, adds that inflation levels are reasonable. Markets snap the 4-day gaining streak. Nifty closes below 9,900 and the Sensex loses 0.25%. ICICI Bank, ITC and HDFC drag the most. Broader markets outperform with mid-cap index gaining over 100 points. State Bank of India puts 24 accounts with outstanding loans of over 3,500 crore rupees up for sale. These include defaulters from the RBI's second NPA list. The bidding will take place on the 13th of October. That's another exclusive. Those were the headlines that we're tracking for you this evening. You're watching CNBC TV18. I'm Arundhati Ramanan and this is Reporter's Diary. Straight to the top story, the Uday Kotak-led Committee on Corporate Governance Reforms has submitted its report to the SEBI. Now, in its 170-page report, the panel has made some important recommendations on the composition and the role of board directors. Now, these include the recommendations on the number, attendance and skills of directors. The panel has also shared its views on issues like gender diversity, as well as the separation of the roles of non-executive chairperson and the CEO. Now, market regulator SEBI has sought public comments on the report and has set 4th of November as the deadline for that. We have been interacting with the members of the Kotak panel. Here are some exclusive excerpts of their reactions.
The idea of improving corporate governance here was focused on a concept of moving from a monarchical model, a Raja model as you put it, to a custodian model, which is like the Gandhian model of trusteeship. So the idea of serving all stakeholders, having a governance that serves all stakeholders was very much the motivation behind this 171-page report.
So, as you said, the recommendations try and move corporate India from a Raja model to a trusteeship model. But let me ask you specifically about some of the recommendations and how different they are from the current provisions. A minimum number of directors on a board, I believe currently there are no specific provisions. You're proposing 6 minimum directors. Gender diversity, and this one, more power to the committee, at least 1 woman director, and this time you're very categorically stating an independent director. In terms of attendance of directors, there is currently no specific provision. You're saying they must attend at least half of the meetings over a 2-year period. And this is also, I think, very important in the context of what we see happen on Indian boards. Disclosure of expertise and skills of a director. Currently, again, no specific provisions, but you're now proposing that boards must have a matrix setting out the skills and the expertise and the competence of a particular member related to the industry that they serve in.
Right. So really a board has 2 big purposes. One is the fiduciary to all the stakeholders. The second is adding value to their investment in some sense, to strategic thinking and so forth. For the latter aspect, if you don't have the right mix of expertise, the board cannot do its job. And then fundamentally, the board must do its job. They've got to be enough members to attend meetings, have quota, etc. They've got to attend the meetings. They've got to be mechanisms in which they can evaluate themselves on how the board is performing. So the whole idea of the report in the board section was to strengthen the role of independent directors, to move towards having a separate chairman and chief executive over time, and really emphasizing that independent directors and boards have a great responsibility in improving corporate governance.
Why did you feel the need to say that the woman director must be an independent director?
Well, because the whole idea, there's the idea of independence and there's the idea of diversity. So independence means it's not a director that belongs, say, to the family of the promoter.
Which is what we've seen happen.
Which often happen, and it seemed to make more sense to really bring about the concept of independence. Clearly, you wanted an independent woman as opposed to just a woman.
I think there is a much higher degree and focus that the committee felt should be highlighted on the role of the independent directors. I think that there were several issues where related party transactions were re-looked at and a bit of squeezing and tightening on that. There was a requirement of some policies to be framed and put in place, like materiality, information sharing, etc. And I think one of the things that we decided was to separate in time to come and give a path forward of the roles of the non-exec chairman and the managing director.
In fact, we now have another member of the corporate governance panel, N. Venkatram of Deloitte, and Mr. Venkatesh, corporate governance expert and well-known chartered accountant, also joins us. Kritika Saxena is here for that conversation. Kritika, over to you.
Thanks for that, Arundhati. Mr. Venkatram, let me come to you first. Take us through the guiding principle that the panel followed, according to you, that led to the final recommendation being put forth.
Many eminent people before me have spoken on the guiding principles, so if I can just limit myself to the accounting and audit aspects.
Sure.
I think here again, what we were really looking at is to say, is the need of all stakeholders being met? We were looking in terms of disclosures which are being made, the availability of information, the instances of default that we have seen in recent times, related party transactions per se, etc., and what could be the role of gatekeepers such as the auditors in such situations. And so therefore, if you would like me to continue, I can probably talk about 2 or 3 areas.
Yes, please go ahead. Go ahead.
Looking at.
Yeah.
The first would be around qualified financial statements, to say where the auditor issues a modified opinion on financial statements. And the question there was, could that qualification or modification have been avoided? And we also looked and did some research in terms of whether in instances where you have modified opinions, possibly if those had been avoided and there had been more disclosure and clarity, situations of default could have come to light earlier. And we deliberated the issue on qualified opinions and said that while we would recommend that this should be kept to the very minimum, we also increased disclosures around estimates that need to mandatorily be made by management when accounts are qualified on the impact assessment itself. The second area was really around the whole concept of material subsidiaries and the governance around material subsidiaries. As you know, material subsidiaries were subsidiaries where you had 20% was the threshold. And the committee deliberated and thought that perhaps a 10% threshold for the material unlisted subsidiaries would be more appropriate. And that is really what is in the report at the moment and the suggestion that has been made. This is pretty significant because if you really look at it, there are a lot of other associated related clauses that then tie into this. And from an audit perspective, one of the suggestions and recommendations made by the committee was that in instances of material unlisted subsidiaries, the primary auditor should also take responsibility for the audit of those companies. I think that's pretty significant considering the fact that we have seen instances where funds can get diverted through subsidiaries, etc. So that was perhaps...
Mr. Venkatram, before you outline the other 2 points, just a quick question as far as the unlisted subsidiary angle is concerned. Can you take us in terms of enforcement, what are the points that have been suggested by the panel which will ensure that transparency there as far as subsidiary angle is concerned? And will this also simplify large groups having multiple entities? Will it also simplify the cross-holding structure across these entities?
Well, the simplification was a different point, but if I just stick to the issue of the material unlisted subsidiaries, one is the question of whether, or the suggestion that you should have an independent director on the material unlisted subsidiary. The second is when we were looking at the group format, we were covering material subsidiaries not only in India, but even outside of India for the purpose of the auditor taking responsibility. We were also looking in terms of internal controls over financial reporting and extended the ambit of that scope. The suggestion was that the scope of looking at controls over those subsidiaries should also be extended to all subsidiaries, not just the subsidiaries within India.
Okay.
So in a sense, it is also recognition of the fact that many Indian listed companies also do have overseas operations.
Okay. I just want to expand on the point of increasing the responsibility and scrutiny of audit committees. What are the changes that will ensure this? What are the key changes, according to you, that have been proposed that will ensure this?
Well, I think the most important thing is recognition of the fact that 4 audit committees a year could largely be insufficient. And therefore, the recommendation that they should enhance and increase the number of audit committees. Also within that, the fact that all material unlisted subsidiaries would also come under the oversight of the audit committee. I think these are the 2 most important things from my viewpoint.
And from an accounting perspective, will there be significant changes from what we are seeing in terms of pure accounting principles right now? And why the need to put forth and tighten the accounting principles then?
Well, I think it's more of accounting disclosures that we could look at because accounting principles would largely fall under the accounting regulator. What we did really look at is in terms of, say, when you looked at half-yearly reporting. If related party transactions are an issue, why should there be a time lag that related party transactions are only seen towards the end of the year? And therefore, the requirement that in the half year as well, related party transactions should be disclosed in the same format as the year end. That, for example, was an instance of bringing it in. The second important point brought in was disclosure of half-yearly cash flows. Because in any case, in the half year, you also show a balance sheet with the income statement. And the suggestion was that why don't we also see a half-yearly cash flow statement? All this would really help stakeholders and investors in their evaluations.
Okay, another quick point before I bring Mr. Venkatesh, who's patiently been waiting into the conversation. Another point I wanted to ask you was the need to disclose fundraising. So there's a point that says the disclosures will have to be made on utilization of funds raised by QIPs or preferential allotments. Were there instances where there was lack of clarity, and will this increase the transparency and reduce the kind of fund diversion that you typically see in case of some companies?
Well, certainly it will enhance governance, and I think that was really the intention.
Okay, let's bring in Mr. Venkatesh also into the conversation. Mr. Venkatesh, you've heard some of the salient features. What to your mind stands out, and do you believe that this will do the necessary trick that corporate India has been talking about to increase transparency?
See, first thing first, I have not read the report on mortality. Unlike the other speakers, 4 or 5 of them who had the pleasure of being on your show, I had the ringside view of the entire report being formulated, discussions, and cross discussions. Unfortunately, I was privileged to be there. So to that extent, I am handicapped, and I've just been perusing the report. What I should see from the report, I have 2 basic points. They started looking at the entire issue of checks and balances in the corporate governance issue. The presumption of independent directors alone. In short, we have come to a point that beyond independent directors, there exists nothing in terms of putting checks and balances in a corporate sector. So to that extent, we are so keen about strengthening this that we have even gone to this extent of doing some gender diversity issue as a very titillating point in a corporate governance. I'm not against it. Let me say that I'm not against women there on the board. But desire to bring in...
Right. Mr. Venkatesh, we're going to try to connect back to you. We have you on a very bad line. We can't hear you very clearly, but we're going to connect back to you. Mr. Venkatram, before we wrap this conversation, one last point. As far as the active changes are concerned, what to your mind is going to require the most consultation by corporate India?
You're saying broadly across everything else?
Yes.
I think it still is a mindset change because, I mean, we are a very intelligent people, and I'm sure that, there will be folks who will look at it and say, oh, well, is there a workaround?
Be it in accounting, disclosures,
I think in accounting, sorry to interrupt you. Yeah, but I think that in accounting, the major thing that would come up is really where the accounting regulator would also be in the picture, because some of these could be sensitive. For example, when you look in terms of giving the primary auditor more responsibility of the audit of financial statements, that would essentially mean that he would audit the company as well as material subsidiaries. And that again always, brings up questions of, will that mean there is concentration of fewer auditors doing the work? Would it not give enough opportunity to others, etc.? But a lot of what has been really brought in is in line with global practice and something that has been working in other jurisdictions and something we should aspire to do. So yes, there will be a little bit of debates around some of those issues, but I would hope and think that most of what we have put in the report is really time-tested, either here or in some other jurisdictions at times, and has also been evaluated very carefully.
Okay, Mr. N. Venkatram, thank you so much. Appreciate you joining in and taking all the time to speak to us and help us with the fine print. And Mr. M. R. Venkatesh, thanks very much for joining in. We will try to connect back with Mr. Venkatesh since we had him on a bad line. Arundhati, remember, October 2018 is the timeline. So they have about a year for consultation. But like Cyril Shroff, Zia Modi, as well as Mr. Gupta pointed out, 4 months typically should be the timeline that SEBI will take to finalize the norms.
All right, absolutely, Kritika. Thank you so much for taking us through that. On that note, let's take a short break, but we'll be back with more news and updates on CNBC TV18.